Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, good everyone. How you going? Phil Tarrant here, host of the Smart Property Investment Show. I hope you're well, thinking about what's going to be happening in Australia in a couple of weeks' time as we go to the polls. Some good research about to come out from Momentum Intelligence, which is part of the Momentum Media family of organisations, with some insights around the way in which different communities, professional services, property sectors, what policies will be important to them as they go to the election, and how they intend to swing their vote. We'll be able to report on those findings pretty soon. Make sure you keep connected with smartpropertyinvestment.com.au. There's been some great headlines on smart property investment over the last couple of days, especially sort of giving some narrative around all these different moving parts happening in the economy right now, inflation, pressures, talks of interest rate hikes, ongoing hangovers from COVID and what it means for migration, what it means for property prices. There's a lot of noise around that. The yield component for property investors on the rise, which is pretty good news for most if you're right across it. So I wanted to get through some of these headlines today, give some interpretation of it, go behind the news. In the studio with me to help me navigate this, Steve Waters, Director of Right Property Group. Steve, how you going?
Yeah, good, Phil. Good to be back. Good to have a couple of back-to-back long weekends as well.
Mate, back-to-back long weekends is the way it is, and that's 3 in a row, and everyone's back into work now. It's a short week this week, but then moving on, we're pretty busy at this moment, and always the way is we run up to a federal election that's being held on the 21st of May. So get set. But Steve, just some headlines here on smartpropertyinvestment.com.au that I'd like to get some sense for. First one here, and I sort of touched on it very quickly. Major bank says inflationary pressures on the way up. Westpac predicts core inflation to rise to 4% in the second half of 2022. Westpac economists have matched NAB's previous forecast, placing core inflation at a whopping 1.2% for the March quarter and 3.4% over the year. Well, I think it's pretty clear now. There's been so much noise around inflation. We saw it sort of touched on in the budget. The government thinking some of the easiest ways to combat inflation was to try and give some breaks back to Aussie punters around fuel and fuel excise and see if they could shave some of those taxes off there to try and get continuity on prices. But I think it's a lot more structural than that, Steve. What's the big deal with inflation? Why is it making headlines at the moment?
I think the short answer to that is because it's a fact. We've had many years, decades, in fact, of low inflation, and we're clearly heading into something that's a lot higher than what it has been for quite some time. And to be fair, though, it was always going to happen. I think if the world was, for want of a better term, printing money during COVID, to expect not to have some sort of inflationary reaction, you're just burying your head in the sand. And then you combine that with all the bottleneck supplies around the world, including manufacturing grain, superphosphate, as an example from the Ukraine war as a byproduct. All of this has a flow-on effect, and it was bound to happen. And here we are. Then locally, you give the subsidies, you allow the credit to flow at a rate that it hasn't been seen in quite some time, and we are where we are today. And I don't think it'll get any better for the short term.
No, not at all. And you mentioned global factors impacting our domestic economy here. Who would have thought? We would have thought that we'd be a semi-major European war again in Europe, sort of 80 years after World War II and 108 odd years, what it is, after World War I. But that's taking place right now, and the impact on a globalized economy is being seen. And for those that don't know, Google what Ukraine does. It's a massive, you should look at it on a map, it's a massive country, huge in terms of its natural resources and agriculture, the breadbasket in many ways of Eastern Europe. So, this is not a discussion around Ukraine right now, but look at the flow and impacts of that in terms of energy here in Australia. And you look at this report here, Steve, housing costs are predicted to make the largest contribution to inflation of 0.67 percentage points. Next is transport, up 0.38 points, contributing. That's auto, fuel, motor vehicle expenses. Food is not far behind, 0.335 PPT contribution. Supply, broken in by category. Westpac is forecasting 1.7% increase in bread and cereals, 6.6% rise in fruit and veg, a 1.7% rise in meat and seafood prices, and 5.6% rise in dairy prices. So they're tangible uplifts in the cost to live. Rents too, obviously as a property podcast, expected to experience a quarterly boost there of 0.7% nationally.
I think they've got that wrong.
The pack higher.
Yeah, I think that'll be bigger. I don't think they've got a grasp on just how much of a crisis the current accommodation scenario that we have is. And now that those borders are open legitimately, with very few hurdles, if any, now to come into the country, if we do get a big influx of people nationally, where are they going to live? And then you couple that with the effect of the building materials, which was mentioned in the Westpac report as well. That's not going away in a hurry. In fact, it'll probably get worse as time goes on. And think about it in just such a micro point of view. I mean, you've got China now that's locked down Shanghai, which has an enormous effect to the rest of their country and to the manufacturing that it is, where we still get a lot of stuff from, and those supply chain issues that go along with that. And it doesn't ease the burden at all. And so we're into this now for the foreseeable future. So as a result of that, and coming off what the banks are talking about, we will see the cost of money increase. It's as simple as that.
It's as simple as that. We will do. And interesting, everyone's talking about, it's funny, you don't really hear it a lot, but all these things are going up in value, but property is going to go down in value, right? And we go, isn't that counter-cyclical to inflation? Westpac says here, similarly, Westpac foresees a 5.4% in dwelling purchase prices, noting that prices are catching up following a lull instigated by the home builder and other state-based housing grants. According to the bank, grants have held the effective price of dwellings 3% below the list price, with the gap expected to close in the March quarter. So inflation's going up. You would assume that prices should be going up as well, but you read the headlines, mate, it's completely opposite.
Look, to be fair to the economists, I'm really quite certain that they're grappling with what the potential fallout outcomes are going to be over the next, call it, years. This is not something that's in the books. It's not in the rule books. It's not in the history books to be able to say, well, with this action is this reaction. This is a very unique set of circumstances without shadow of a doubt. And along with that comes scenario situations that we probably haven't experienced altogether, forever. And there will be winners and there will be losers out of this moving forward without a shadow of a doubt.
Yeah, there will be. And I think property investors that are well placed should do well in this next market. And this is interesting. You spoke there about the increase of rents purely through supply and demand. And when you apply an influx of migration, it's going to be even tighter. One of the problems we have right now in terms of the housing crisis, it's not really affordability. It's whether or not we've got enough houses for people. So building properties at the moment is a core focus. However, that's got its own supply chain problems, both in terms of material and labour. It's a really interesting story here. Steve, all interconnected on smartpropertyinvestment.com today, with investors bank on build-to-rent sector for future growth. So this is something which is super popular in Europe and other parts of the world, where large corporations will build a big high-rise and keep the lot and rent it out rather than selling it all. So this is going to be something that you're going to see becoming a lot more popular here in Australia. And I think this is as Australians and Australia grapples with the idea of the great Australian dream, maybe now is not actually owning a 3/4 acre block or whatever it was, or a 1/4 acre block and putting a picket fence on it, right? This is high rise inner city living. The story says the Australian build-to-rent model is gathering pace, according to a new report, with more new players decided now is the right time to grab investing opportunities in the burgeoning sector. Biz Oxford economists' latest report showed that there are approximately 25,000 planned build-to-rent units, BTR units in development around the country, with 5,000 expected to break ground annually between 2022 and 2023. Well, who knows what's going to go on with that, because a lot of these builders are going to the wall. But with build to rent taking a bigger share of the move to apartment construction, this segment is anticipated to grow at over 10% of the national new apartment supply by 2025, the report forecasts. So maybe the build to rent sector, this is large scale residential development, will be the bastion of the institutions, and the mum and dad investor, guys like me and you, are providing rental accommodation out the burbs, mate. Who knows?
Well, I we already do it, don't we?
Yeah.
In a very small micro version of it. We're just not institutional, I guess. I think the problem that, and people need to be wary, is when we're comparing ourselves to the larger European communities or the American, whatever it may be, with much more densified population and that inner city living. I would be very surprised that along with the build to rent doesn't come or doesn't necessitate higher immigration patterns as well, which are then channeling people into those areas, because the government and the builders don't want to be building something that people won't reside in. Do I think it's a good idea? Depends. Do I think it will be successful? I think probably some will be successful at it. But in the back of my mind, because we don't have, I guess, the densified population as those other worldwide locations do, will we see a replication of, to some degree, New South Wales state housing, as an example, who are the biggest landlords in Australia, creating communities that just aren't viable, both from a monetary point of view and a socioeconomic pattern as well? Maybe, just maybe, the build to rent instead of the densified areas are out in the burbs, that open up some of those large patches of land that we still have to rezone, to cut the red tape, to build communities on a plot of land. Maybe that's the way to go. I'm still not convinced on it. I think there will be some success without fail. But I also, if I look into the murky crystal ball, I can see in the future there also being socioeconomic problems with it, but also periods of time where they're vacant because of whatever the circumstances are at the time.
And this is, social housing has been an ongoing challenge for Australia since its earliest days. And it's the obligation of the state, I believe, and to provide our housing for those that can't provide it for themselves. And I think that's, it's one of the great things about growing up in a place like Australia that takes place. But there's been a number of different experiments over the years, and they don't always get it right, where they go down a pathway saying, okay, let's build these big sort of social housing zones, and say, oh, that's not really working. We actually want to integrate it in with the local suburbs, and they keep trying and changing and shifting. And maybe this will be another opportunity to, the government may rent the whole block off, one of these large institutions, and that's what you provide. You have them right now. You're going to need to think of some of the housing commission areas, for example, in Redfern, which has its own socioeconomic problems. They're talking about sort of integrating them out and intersecting social housing with normal housing. I think that's probably works best for Australia, but who knows? Be nice to watch how they go about doing this, and whether or not there'll be a secondary market for build to rent. Maybe that's what they are now, like, off the plan apartments, essentially just,
correct,
secondary market for build to rent. They're just choosing to sell rather than keep.
Well, maybe it's even, looking to incentivize the individual to provide the accommodation, because as once again, just using New South Wales state housing as an example, they've clearly said we are not in the business of big landlords, and nor do we find it viable. And as a result of that, for many decades now, they've been slowly and systematically selling the assets as they become too expensive to run, so to speak. And if you look at the build to rent from a corporation point of view, well, potentially they would argue that we're already incentivizing the individual federally via, say, depreciation or negative gearing or what have you. Maybe that's something that they could look a little more laterally along, so that you don't have corporations that are providing lumps of accommodation. I just don't see that as it's
not viable for Australia.
No, I don't. But the governments also have an economic responsibility to get people back to CBD locations.
Yeah.
And right. They need that wheel to spin from the localized economy point of view.
Well, you look at just at a sort of localized area. If you think of Mount Druitt, Wayland, Tregear, Durrock, what else out that way? It starts with E.
Edmonton.
There was that, 10 years ago, all that social housing was sold off to investors largely, or owner-occupiers. And I think it's been largely a positive thing for areas like Mount Druitt. And you saw that in their sort of, the subtle sort of gentrification in how those suburbs look and feel. Now you've got $1 million houses out that way, right?
Well, it does. It is the subtle gentrification of an area, for want of a better term, because nobody looks after a dwelling better than the person who owns it and lives in it.
Yep.
And it changes very quickly the streetscape and the patterns, of that particular area. And that's replicated throughout the whole of Australia. I'm only just using New South Wales as an example.
Yeah.
Same in Queensland and every other state and territory.
Well, Melbourne's been an interesting market of late. And with the story here is smartpropertyinvestment.com around property market update in Melbourne, March 2022. So we normally write these up when the month concludes. Let's have a chat about that, Steve. We'll just go to a break before and stay with us. Back in a moment.
Creating wealth through property investing starts with getting the right finance in place. At Finny Mortgages, our brokers specialise in investment loans. We know the ropes to get even the most complex deals approved fast. With easy access to over 50 lenders, we have the know-how and connections to get better rates, improve cash flow, and release equity fast. So if you're looking for a mortgage broker that gets property investment, book in a call with a Finny broker now. Head to finny.com.au, that's FINI.com.au today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Steve Waters, Director, Right Property Group. We're behind the headlines trying to get some sense to it all. Steve, property market update, March 2022 for Melbourne. The autumn season didn't just bring a chill to the air, but Melbourne property market too, as the city's dwelling values fell in March, as the factors that drove growth throughout the boom continue to lose their edge. Experts warn of faster declines in coming months. So this is interesting, Steve, because you read some stories and you would think property markets right across Australia are in free fall or cooling, and that's not the case. There is many markets still forging ahead. This says here in 2021, Sydney and Melbourne were the standard bearers for uniform property boom that saw prices skyrocket in every capital city. But this year is different. At the end of the first quarter of 2022, we're looking at a more fractured Australian property market, one in which the two biggest cities in Australia are on the tail end of a property frenzy and lagging behind their capital city peers. According to industry observers, the factors that have given the cities a golden touch in the previous year have now lost their potency. And the white-hot real estate frenzy in New South Wales and Victorian capitals is now all but dissipated. Recent data revealed that property price growth in Sydney and Melbourne has come to a standstill and cutting both at markets well and truly peaked. Now, Tim Lawless, who we know, Steve, over at CoreLogic, he's a research director. He joined the chorus of real estate commentators who believe that the boom is over Sydney and Melbourne. Quote, "We now see these markets either right at the top of their cycle and about to start to move into a consistent downward or potentially already moving into a downturn," he said. CoreLogic's data, Steve, showed Melbourne's housing market had been quarterly growth rate slow to 5.8% in April last year to 0.1% over the last 3 months. Are you seeing this ground truth on the ground?
Certain areas we certainly are through both Sydney and Melbourne, without a shadow of a doubt. But there are still select areas that are performing normally, dare I say it. I mean,
normally is good.
Yeah, well, it is. And the paradigm is it's, from not Tim here, but just the media in general, is that there can never be a happy ground. It's either boom or bust. There's nothing ever in the middle, I guess, because it doesn't make headlines. But there are certainly areas that have contracted, and we've seen areas of Sydney and Melbourne do that. But that's also coming off the back of some record growth. So when we reverse engineer those numbers, maybe as the future rolls on, they'll be in line with their historical averages.
And you're going to go back and look at this in a moment in time, 2 years' time, and go, okay, that looks. You're going to be a slight wiggle to a bar graph or a column, and you go, yeah, that's all a normal market. Interestingly, and then I tend to subscribe to this point. Commonwealth Bank head of Australian economics, Gareth Aird, weighed in that the figures are a testament to how some buyers have hit their limit on what they can afford to pay for a property. And that just
there it is.
There is a ceiling of what people can afford to buy, and therefore, again, it's supply and demand. If you have less people that can afford expensive properties, it stabilizes the prices and it just sets a price point for properties that can't go up. Well, property will continue to go up in Australia over the years ahead, but it's going to move in peaks and troughs.
It's never vertical.
Only so much you can pay.
It's never a linear growth chart, so to speak. It does have those peaks and troughs and rolling up and down. The trajectory is up, however. But look, I would agree with what he says. And in every cycle that I've experienced, there becomes a moment in time where the ceiling has been reached. due to affordability in combination with funding elements, I guess is a way to put it. And we are at the end, I would guess, or in that top quartile of the lending cycle, where the credit has slowed via the different mechanisms in behind the scenes. And that plays with the amount that the banks are willing to lend and also in line with what people can afford. Because there are two types of affordability. One is what the banks tell you can afford, and the other is what you know you can afford. And often the two are not on the same page.
No, and you need to determine that yourself. But I think finally, I think one of these economists have got it pretty right. Steve, he added that the major capitals have likely peaked and values fell due to buyers' already stretched budget. Yes, that's right. And that's their budgets, not what the bank says you can borrow. The evidence is pretty clear. He says prices have peaked in the two biggest capital cities. Affordability has become stretched because prices have gone up so much. There is a limit on how they can go, how high they can go. You can't continue to grow indefinitely, and that affordability picture has kicked in early in Sydney and Melbourne, he said. So, what needs to happen now is it's just got to be this point, and this is back to the inflation point of view, and then also how that's connected with wage growth, and therefore what the Reserve Bank of Australia, the RBA, will do with interest rates. They actually want to see genuine wage growth before they start tinkering with that. Yes, prices have gone up, but they haven't yet seen that clear wage growth happening. That shows that with this continued price increases, whether or not Australians and Australia can sustain it. So it's pattering out at the property level, whether or not. And you hear these stories, Steve. I don't know what you see in your business of there's little or no wage growth. Everyone I know is getting pay rises left, right, and centre. I don't know what's going on. Maybe just
everybody. Yeah, look, I subscribe to that. I know a lot of business owners that cannot find staff. Everyone from the restaurant owner, cafe worker, through to accountants and everything in between. There is a real shortage throughout Australia. And look, if it keeps that way, well, then there will continue to be wage growth pressures, I guess. Conversely, if the borders are now open fully and we do get an influx, well, maybe that will subdue that rate of growth in terms of wages as well. And I know there's an argument in the back rooms around that as well. So it'll be interesting to see how it plays out, but 100% definitely there is wage growth. Maybe the numbers just haven't been apparent yet. They haven't been reported on.
Well, most of them are struggling, particularly at the hospitality level. You can't find staff these days. They're saying to POMs, come out to Australia, we'll give you a $3,000 sign-on bonus and pay you rent for a little while just to get people into pubs and the discotheques that you probably frequent every Saturday night.
The discotheques, I haven't heard that word ever.
But that doesn't mean that property is, there isn't still challenges with affordability. And we see that as a key election issue as we move on, with both parties pretty much saying as a run up to election saying we will do something on affordability. Well, every political party for the last 100 years has been saying we'll fix affordability, and this election cycle is no distance. But a really interesting story here. We'll get into it. Just go to another break. Back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant from the Smart Property Investment Show with Steve Waters, Right Property Group, getting behind the stories in the news as we lead up to the federal election, and whoever is going to be the steward of what will be an interesting time for Australia moving forward, spiking inflation, rising rates, a more contested geostrategic, geopolitical position for Australia, wars in Europe. It's a very interesting time. But the big thing around affordability, Steve's story here, smartpropertyinvestment.com.au, 20 affordable suburbs within commuting distance of capital cities. And this is always interesting. Most people think, you hear segments will complain about housing affordability in Australia. And yes, if you're 23 years old and you've got your first job paying $55,000 a year, whatever you're getting, guess what? You're not going to be able to buy a $2 million property in the CBD. Just get on with it, right? That's just the way it is. You've got to look elsewhere to start building your wealth. So at a point in time, you can buy that potential forever home. We start investing in those areas. Steve, the cost of housing versus the distance you have to spend commuting to your workplace is an equation that Australians have been grappled with at some point in their lives. That's why each quarter rent Rabbit.com.au releases a tenancy opportunity report to identify the 20 suburbs where tenants can find affordable rents within commuting distance of the state's capital. I'll read some of these out, mate. And this is good for property investors as well. Shellwater, Western Australia, 20 Ks from the capital, $265. Caulfield East, Victoria, 14 Ks of capital, $285. Kingsville, Victoria, 8 kilometres, $300. Brooklyn Park, South Australia, 6 kilometres, $310. All the way out till you get to sort of number 11, Osborne Park, WA, $330. Roselands, New South Wales, 13 kilometres, $335. So rents are still reasonably manageable close to the CBD. It doesn't give you any sense though what you're renting, whether it's a bed sit or a shed in someone's backyard.
Oh, look, as you were reading those suburbs out, I could nearly guarantee, because I know the areas that they're units, whether they're 1 or 2 bedders or studios, I'm not quite sure. So while it's a little ambiguous, the report, if you really do need the accommodation, it is there. Just depends on what you're really looking for. If you're a larger family, call it 3 kids, well, you're not going to be going into a studio at Roselands.
No, you're not. You're probably going to be out western suburbs of Sydney somewhere.
Correct. So what would be really interesting is if a report was done into those subsets.
And that's the point. And a lot of people are obsessed with this idea that investment grade blue chip property needs to be within 5 kilometres of CBD. Choose your number. It doesn't matter. It's going to depend on where the capital is. And there is some merit to that argument. However, that doesn't need to be of a 2,000 postcode, 3,000 postcode, 4,000 postcode, 8,000 postcode. If you take the Sydney metropolis as an example, you've got 10 big CBDs all located within it that have their own mini micro economies. They're cities in their own right. Blacktown, for example, is a city. And if you draw a bubble from, the central coast of New South Wales up around Penrith and down to the Shire, you're going to catch a lot of micro CBDs in there where the same adage applies. Yes, you need to be able to live your life and associate yourself within that immediate connectivity. And I know people that are investing in Hornsby. I know people that are investing in Parramatta. I know people investing in Penrith. I know people investing in Campbelltown. I know people investing in anywhere. The logic holds true, but you don't need to be in a capital city postcode for that to hold true.
No, not at all. I've never subscribed to that. And
you read stories sometimes and you would think that's it. The CBD has to be a major Australian city to be a city.
Look, yeah, I read interestingly enough, I read an article by someone else, wouldn't be a week ago, saying exactly that. You must invest, if we call it postcode 2000 or 5 minutes around it. And, I think it's a very dangerous piece of narrative. I mean, if you're wanting to invest and if you've read an article like that, you'll be saving for the next 20 years before you can afford to
and it's
invest
unaffordable.
in that area.
It is
Correct.
actually unaffordable for most.
Correct. But it's also unaffordable for most of the tenants. I mean, the mortgage belts, as an example, throughout Australia, hold the most people. And they have great infrastructure, great employment nodes, great transport, schools, hospitals, because that's where the majority of Australia live. Now, granted, if you were to have a $2 million asset and got 10% growth versus a $500,000 asset and got 10% growth, well, the dollar amount is clearly more attractive on the $2 million scenario. But let's start to equate what the holding costs of that and the difference between income and expenditure and the pressures that they may put upon certain individuals to control that, if you subscribe to that theory only. Now, I'm not saying that it's not a good idea. I just believe there's a dozen, 2 dozen, 3 dozen price brackets throughout Australia where you could invest into and get good results, but it all comes back to your own unique circumstances.
It does. It's just taking off the blinkers and looking at each individual market. And the same applies for regional markets. And you think of, I sort of mentioned Sydney there, the Central Coast is like one of the fastest growing regional areas of Australia right now. It is part of Sydney, but it's its own micro climate, its own micro economy, and it's rocketing along. And Steve, you must be seeing good value in regional markets at the moment. Anywhere specifically or in particular that tickles your fancy?
Well, you mentioned the Central Coast. We get one time per cycle to enter, in other words, purchase on the Central Coast and Wollongong, because they're like bookend markets.
Yeah.
And we started buying there just after the last federal election. And then as COVID hit, we doubled down. Now, prior to that, it was the midst and the end of the GFC that the numbers stacked up for us. And we've seen tremendous growth over the last, let's call it 3 years on the Central Coast in all walks and shapes and fashions. But what we're also seeing to this day is such an undersupply of accommodation where even 2-bedroom granny flats, as an example, are getting $400 to $420 per week, and people are fighting for them and offering more money and prepaying in advance to secure the accommodation. Now, this goes all the way back to the accommodation crisis that we were talking about earlier on. But there are regional areas throughout Australia that are experiencing the same type of phenomenon around that lack of accommodation and growth. But the question is, has COVID exposed these areas in a good way, or are there some areas throughout regional Australia that are reacting as a result of COVID and may not have the sustainability? And time will tell.
Time will tell, and it looks like this flexible working lark's around forever now. So I think structurally how Australians will work will be good for regional markets moving forward. And we've all seen the numbers go up in all these areas. And whether they're going to force Aussies back into the office, I don't know. But if you've got these knowledge workers who are able to live in these regional areas, the flow on is that those local economies shine. They need electricians, they need plumbers, they need their fancy city coffees, they need their fancy city restaurants, they need their boutiques and bottle shops and all that sort of stuff. So these are all, this population shift, which is a COVID pandemic outcome, I think will hold Australia in good stead moving forward. There's one story here, and we'll probably close with this, Steve, on smartpropertyinvestment.com.au. Gold Coast $1 million property club grows amid pandemic boom. The number of properties on the Gold Coast fetching 7-figure price tags significantly increased during the pandemic, new analysis showed. While other markets predicted peak in the coming months, the premium Gold Coast market has shown no signs of slowing down, with more than 5,600 properties selling during the last 12 months for over $1 million. The figures are a staggering 67.4% jump from the 3,778 trophy properties that have sold in the region during the previous year. Like the Gold Coast is peak and bust, feast and famine. Maybe this is just another cycle of it, but no doubt accelerated that whole southeast Queensland, Steve, accelerated by COVID. Brisbane, southeast Queensland is booming at the moment. Thankfully,
Sunny Coast.
Finally.
Yeah. Well, look, it's in relation to the Gold Coast. You mentioned it is a sort of a peak and bust type of market. This type, it may be a little different, and that it really does depend upon the unit market and the pipeline that's with it, because there is a big part of the Gold Coast which has always necessitated, or the accommodation has been there for the population that is not transient, which then turns up really around the unit or attached accommodation. You combine that with the fact, as you mentioned, that potentially the well-paid white-collar worker, because of COVID, has changed locations from whether it be Sydney or Melbourne, predominantly into these areas, and the Sunny Coast is another great example, and Brisbane, because their employment type allows them to do so. And I've had probably 14 to 16 clients who have done exactly that, who have lived in Melbourne and some in Sydney, and they've owned their houses in, say, Melbourne, and they've moved to Queensland and bought again to reside up there because their work allows them to do so. And in fact, probably over 50% of their employers have encouraged them to do so. And these are mainly in the tech space in some way, shape or form. But with that, and you mentioned it as well, with that, when you have the high paid, high disposable income cohort that move into an area, along with that, almost starts to self-propel the localized economy because of the need for services. And it becomes a revolving, self-fulfilling prophecy to somewhat, as long as the employment scenario stays solid. Because at the end of the day, you need jobs.
You need jobs. Jobs
it's not just
important. But you look at the unemployment rate. So even, I was talking about this sort of great reshuffle. If you want a job in Australia and you're a knowledge worker, you're probably going to be able to get yourself a job pretty easily. So the continuity of those jobs will remain. It's just how long that will remain for until you see, again, supply and demand. I think whoever is successful come late May at the election, be a agenda item for them is going to be, skilled migration. We're going to get more people into Australia as quickly as possible. Whether or not that'll buttress property markets moving forward, who knows? But one good indicator, Steve, when you start seeing dog groomers arriving on your high street, there's a lot of money Washing
Have you got them? Have you got them? Look,
when you start seeing small bars, dog groomers and fancy restaurants rather than fish and chip shops, there's a good indicator, mate, of gentrification is in place, and nail salons.
Nail salons, yeah. It will be very interesting to see what the immigration patterns are over the next 12 months, because that's, as we've mentioned earlier on, that could very well underpin the value of residential real estate as that sort of downward pressure on, or upward pressure on the rents continues to go along. And therefore, as we've discussed before, the commercial filter upon residential real estate will really come into force and underpin the value. Cool.
Well, mate, we got through some headlines there. Give them some sense of the world.
We did.
Good time to be investing in property, no doubt.
Look, I think it's always good. It's just really depends on where, what, and how.
Yeah, that's the secret.
It is.
Who knows? I don't know. Don't ask me. But I know some people that do know. Anyway, Steve Waters, Right Property Group, thanks for your time today. Do enjoy it.
Pleasure as always.
Nice. Remember to check out smartpropertyinvestment.com.au. Any questions that you have for us? We're probably due a Q&A episode. I'm sure Steve will be happy to come on. We're happy to answer any question you have. Email the team, editor at smartpropertyinvestment.com.au. We'll get them curated, then we'll answer them all on air. Please remember, a quick favour for me, keep those reviews coming wherever you listen to this podcast. Most of you on Apple, the team get a real kick out of it. They do all the heavy lifting with this, the producers and the post-production people, and they are the unsung heroes of this property podcast. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.